Welcome to Going Long with FCLT Global, the podcast that dives into the world of long-term investing and strategic decision-making, hosted by Sarah Williamson. Going Long features thought-provoking conversations with some of the brightest minds in finance, economics, and business today. Each episode will bring you exclusive interviews with renowned executives, investors, and experts who are driving change in the world of finance, getting their unique perspectives and uncovering strategies that have shaped their success. Whether you're an investor, a business leader, or simply curious about the forces shaping our global economy, join us as we explore the power of long-term thinking. This is Going Long with FCLT Global.
Welcome to the Going Long podcast with FCLT Global. My guest today is Adel Alderbas. He's the Chief Investment Officer of Wafra, a New York-based alternative investment firm with over 40 years of history managing $28 billion in assets across three primary verticals: strategic partnerships, real assets, and real estate. Adel began his career at Wafra and worked there for 5 years before attending Harvard Business School. He then returned to Wafra in the newly revamped alternatives division, focusing on direct investing and real assets. In 2022, he officially became Chief Investment Officer as well as President of Wafra's GP seeding platform, Capital Constellation. Throughout his tenure at Wafra, Adel has been instrumental in driving the growth, innovation, and fostering partnerships, significantly expanding the firm's client base to include over a dozen prominent investors from the U.S. and Europe. Adel, welcome, and thank you for joining me today.
Thank you, Sarah. It's a pleasure for me to be on this podcast and talk to you today.
Great. So can you start by introducing Wafra a little bit more? Give us a little bit more background about Wafra and who you are and sort of what your approach is to long-term investing.
Excellent. So it's very befitting to be talking about long-term investing because, as you mentioned, this year we're celebrating our 40th anniversary as an institution. And that's an important milestone for us. We're celebrating our history and we're looking forward to march ahead with our focus on alternatives. Historically, we've been more of an inward-focused organization that mainly focused on catering to our parent company, which is the pension system of Kuwait. I would say as we evolved as an organization, it became really competitive. So that forced us to innovate and look outward and, carve out differentiated strategies that would make us relevant to a pension system that saw all the largest asset owners come to their doors and come up with a lot of ideas. So I would say about a decade ago, there was a transformational moment at Wafra where I give credit to our current CEO. And we said, we have to have differentiated strategy. We can't just focus on catering to our parents and providing them with a full suite of investment offerings. And that has led us to where we are today, which is an alts-focused investment firm, 200 people based in New York, around $28 billion of AUM, and focused on three main strategies: strategic investments, which is more commonly known as GP stakes. The second is real assets. And the third pillar is our real estate investing program.
So as you think about, let's talk about each one of those things. The GP stakes are, you've taken a very interesting approach to this. So you've formed Capital Constellation, which, as I understand, is a partnership among a number of different large investors around the world to work together to take stakes in GPs and then work with those GPs. But can you describe that a little bit more? I think it's a fairly unique model.
Yeah, of course. I'm happy to. And I think Capital Constellation encapsulates exactly what Wafra is about, which is we lean on our DNA as an institution that is closely linked to one of the largest LPs globally. So we have that humility of an LP, but we also have the rigor of a GP. So when you combine those two, we get something like Capital Constellation, which is a very innovative, collaborative ecosystem of asset owners and asset managers led by Wafra as a GP, but using that ecosystem as its edge. So today, that asset owner network is around a dozen of the largest asset owners globally, who have entrusted us to invest in investor entrepreneurs and newly established asset management firms, or asset management firms that are early in their innings. So we've been at that for over a decade to date, Sarah, and it has been a great journey because we started initially with only our parent as our backer. But today, our value proposition to these investor entrepreneurs who are leaving, some of the best shops in the world, got further reinforced through our partnership with other asset owners who, help enhance our value proposition. What we do is we provide the initial check. It's typically between $150 to $200 million to an investor entrepreneur who leaves a large, well-established platform. We got this idea by looking at our ecosystem of asset owners and saying, it didn't make sense that these large asset owners would not give first-time funds a chance just by mandate. It also is a rigorous underwriting process for them. But if you look under the hood, what we realized is, these opportunities are, ones where you wouldn't only benefit from the LP return, which usually in these strategies, or if you look at data, has been an outperformer, but you also get something in addition. You get an ownership stake in an asset management business. So it's return plus, which is a unique value proposition to our ecosystem of asset owners.
So one of the challenges that asset owners have, as you well know, is they perhaps have liabilities that are 20 years or 30 years or whatever they might be. They do have some constraints, like maybe not investing in a first-time fund or whatever it might be. But on the other hand, they want to invest in things that are new, keep their portfolios vibrant, keep them invested in the new economy, invested in innovation, all of those sorts of things. And so are you thinking of Capital Constellation as sort of a way to bridge that very long-term, stable goals in capital, but also this activity in the shorter term? How do you bridge those two?
Yeah, it's an interesting question that we always think about. When we engage in seeding a platform or buying a GP stake, we're not thinking about the next 5 years. We're not thinking about the next 10 years like a typical private equity investment. We're looking at this as a multi-generational investment firm that transcends beyond the initial founder and beyond the existing management team. So we help those investor and entrepreneurs who are early in their journey think about, how do I build a sustainable business that goes beyond me? And that's why, Sarah, I always emphasize that we don't back investors, we back investor entrepreneurs. And the most difficult thing in this business is not identifying the investors. The investors, identifying them is a science. You look at their track records, they look good. That's a great investment. You'll make money in 5-10 years. The question is, are they entrepreneurial? Can they build a thriving business? And can they be value add to our asset owner network on a long-term basis? Because our asset owners are initially taking risk with a startup, so they have to see a long-term benefit. And initially, that benefit is, these investor entrepreneurs are going to have, more interesting ideas. Typically, they're investing smaller checks. They're more nimble. They don't have legacy assets. So they're going into like super interesting sectors of the market, whether it's digital infrastructure or energy transition. And that's really attractive to asset owners. But what also attracts them is, in addition to getting, that entrepreneurial exposure from a portfolio perspective, they're also getting GP ownership. And that adds a very interesting return enhancer to this portfolio.
So oftentimes what investors see is if they give money to a new firm, that firm grows over time and their interests diverge because the early investors perhaps get diluted and so on. But it sounds like the model that you've built, that those interests are much more aligned because as investing in partly in the GP and also in the investor entrepreneur, as you call them, your fund and your partners want that business to be successful as a business. So you're sort of a bit more on the same team than oftentimes happens between a growing asset manager and their GP.
Yeah, definitely. And just like anything in life, there's an emotional aspect to it. If you put someone in business, they're always going to be loyal to you. They're always going to have your best interests at heart, whether it's 5 years, 10 years. And there is a connection there. And we've seen those investment entrepreneurs continue to deliver for their owners. We also see better alignment early on because typically these investment entrepreneurs are leaving great seats where they have a ton of carry, where they made a lot of money, where they can make a lot of money. So they're taking a lot of risk to start this venture, and knowing that they have partners in Capital Constellation, 12 of the largest asset owners who have economic linkage, which is the best form of linkage in their business, is something that provides them with the comfort to focus on the investing side. We've seen our ecosystem get really active with these investment entrepreneurs, not only through investing in the fund, but investing in co-invest, which is a priority for a lot of LPs now. Typically, these earlier funds have more to offer from a co-investment capabilities. So that's something that's really attractive. I think as the market in general gets more intermediated and less relationship driven, our asset owners value like being early on in a relationship with a GP, so that when they scale, they're at the first front seat of harvesting synergies, whether that be co-invest, but even beyond it, like secondary exposure and other things. Intelligence is also a big factor. Like people want to see, where the market is going, and that has been hugely beneficial for our investment program at Wafra. Having owned over 30 GPs has created an IQ multiplier for us. It had allowed us to be early movers in areas like data centers, where we made our first investment in 2015, and only maybe this year or a year ago, people started really like getting into that space. So there is the intelligence aspect, which is less tangible but hugely valuable.
And how do you mentioned you've got a dozen partners in this venture. How do you get a dozen different asset owners to agree on anything? They must all have different timeframes, different objectives, different mindsets. Do they all have to sign off? Do they all agree, or do you just share intelligence and you're still the GP? How does that work?
Yeah, so they don't all have to agree all the time. I think what they agree on is, backing us as the GP, executing the strategy on their behalf, and that's what's paramount. We do keep an open dialogue with them. We're very transparent, but they hire us for a reason, to execute on their behalf, and they appreciate our transparency and our communication. And that has been extremely valuable to us because, that level of engagement is something that the industry has really shied away from, either by structure or by design. Either GPs don't want to listen to LPs by design, or by structure, they can't because they have 1,000 LPs. I think, we have the luxury of having a close-knit community of asset owners who are our advisors, and we listen to them, and they listen to us, and we tend to have a very long view on our relationships and engage in broader things than just a simple LP check and a statement that arrives, once a month or once a quarter with investment results.
Yeah, it's a very different mindset. You've mentioned your other two verticals are real assets and real estate, which are also both quite long-term investments, typically not particularly liquid and so on. How are you thinking about, are these three things quite separate from each other? And how are you thinking about perhaps balancing or the intermingling between these in this time of volatility? When rates are moving a lot. I used to mention things like data centers, which are sort of a little bit real estate, a little bit, all these other. How do these fit together, especially with this volatility that's going on?
So we have something at our platform that we hold extremely close to our hearts, and it's part of our ethos, and we label it as one Wafra. So we don't operate as siloed teams. We cross-pollinate, and we specialize, especially on the senior side. But we all sit around the table and discuss things, because we do believe in synergies and the multiplier effect of information flow. So it's a unique approach, because it's not the most efficient in the short term, but we have a long view on things, and it does pay off. And it has paid off for me personally. So when I first started working at Wafra, I was in emerging market equities, and there was a real asset nexus to emerging market equities. I went to business school. I joined Wafra again, and I helped build our real asset direct investing practice. By doing that, I got exposure to data centers, and then that led me to source a deal on the strategic side, on the GP side. And that's a relationship that we started with that firm in 2017 as a data center investment. In 2020, we bought a GP stake, and we remain a large GP stakeholder. So I think and we have deployed a lot of money into that partnership. We've invested in multiple direct investments alongside them. We continue to own in the GP. Our parent company has invested as an LP. Other asset owners have come in as an LP. So, that's a personal story, probably best resembles what happens here, which is, the power of collaboration, the power of synergies. And it's something that you'll see across all of our platforms. Specifically, going back to your question on real assets and real estate, again, because of our close collaboration with asset owners, we understand what's missing in their portfolios and where things are headed. So on the real asset side, we have been focused on the middle market and areas such as digital infrastructure, transportation, energy transition, and truly the middle market, not the middle markets that other people talk about. We're talking about buying things from moms and pops, roll-up strategies, but into really scalable opportunities. For example, we've been very active in the marina space. The first marina we bought was over a decade ago, and we rolled up the marina industry, and we built the second largest marina platform, and then we sold it. If you look at the news from a couple of weeks ago, one of the largest asset managers globally just bought a marina platform. So I think if you're willing to roll up your sleeves and go early into less institutional asset classes where you see a lot of hanging fruit, where you see an ability to create value behind, besides financial engineering, which in this environment is going to be tough with higher rates, then you're going to be rewarded. On the real estate side, we've also taken a different approach to real estate and said, in real estate land, everyone's focused on the major food groups of real estate. That's residential, commercial, and where there is a real gap is in areas that are less interest rate sensitive. So real estate is a very boom bust industry, and a lot depends on interest rate cycles. And then we identified this area in real estate where there is the intersection of private equity and real estate. So you're underpinned by real estate ownership, but then you own a platform on top where you can create value. What's interesting is, based on us being active in the space for a very long time, real estate people don't like operations, and private equity people don't like owning land. So we've identified this gap in the market that has resonated with investors and has been great for us. For example, we've done a roll-up strategy in express car washes, we grew up a platform from 3 locations to 50 locations, and we've done well in that investment. So just being able to be early and be a leader in areas that are less trafficked, I think is the way to especially navigate this current environment where you're not going to benefit from the tailwinds of interest rate cuts or financial stimulus.
It sounds to me like a lot of what you've done is break traditional barriers, which is like GPs and LPs don't work together. Oh yeah, we can make them work together. Or real estate people and private equity people are different. Well, we can make them. It's a very interesting strategy, and maybe pension plans aren't GP, but you've got them to be. So, how do you kind of look for these barriers, and how do you knit people together across them? Because there are a lot of silos in the investment. It sounds like from what you've been investing in, you're often trying to break down those silos.
Yeah, I would give credit to our CEO who is really always focused on breaking these barriers. So he never believed in being siloed. I know this is not being videotaped, but if you look behind me, there's all glass. Like there isn't anything behind me. Everyone can look through into my office, and that has been a redesign. That's our new CEO, who's been in charge for about a decade as CIO prior to becoming CEO, has instilled. It doesn't happen over time. Like even just having glass on your office and being transparent and being available and approachable is fundamental. It takes investments from the top down, and you have to genuinely believe in it, because in the short term, it's a lot of work and it doesn't yield immediate results.
Yeah, I think that is it's such an important lesson for investors, and it's so hard, which is the J curve is true not just in financial returns, but also in cultures or whatever it might be, right? Breaking those things down for the long.
Exactly. That's a great way of pitching it.
So as you look forward from, here we sit today in a world that is uncertain. There's a lot of pressures to deglobalize. There are a lot of pressures on interest rates. AI is really changing things. You've mentioned the data centers. There are all sorts of long-term trends going on that you're trying to position for. But at the same time, it's hard to, avoid the noise of the markets or whatever it might be. As you look forward with your long-term time frame, what are you most excited about? Is it breaking things down and finding this unusual things? Is it long-term trends? How do you start with this quite volatile world and say, well, let's focus here and let's leave that one aside?
So as I mentioned to you, I started my career in emerging market equities, and it was just before the financial crisis. So I've lived through the volatility of equities and how that can impact even the way you think. Um, Today at Wafra, we don't even have public securities. It's an area where we think, as you look at data, like passive funds have outperformed active funds, and you've seen like fee compression to a level where you can't retain best-in-class talent to create alpha, so it becomes a vicious cycle. And I would say like the beauty of private equity is, you don't have that short-termism. You look at today and you get excited because you think, I'm going to embrace complexity. I think this is how I can create alpha and really differentiate myself from others. Because at the end of the day, it's about can you execute, can you create alpha, or you're going to write a beta wave on a go-forward basis. And, there's no, I don't think we're going to have a wave of beta lifting us. So it does excite me because our strategies are ones that, one, are focused on alpha creation, bottoms up execution, and then two are long-term focused. So, like the market could be up or down, but my view is, I have a 5-year plan, I have a 10-year plan, I have, sometimes 15-year plan or 20-year plan. And I have an execution strategy, and I focus on what I'm executing on.
I think there are not that many people in the market today who are saying, I have a 5-year plan, a 10-year plan, a 20-year plan. And that's that's got to be that's a differentiator in terms of just the backing that you have.
Yeah, I'll tell you, like it's still difficult, right? Because people still have to manage their portfolios. So from my asset owner network side, like people are now dealing with the denominator effect, and they're saying, oh, like now I'm over allocated to private equity or real estate or private credit, which means we'll probably get less allocation from them when we best need it. But that's how it usually works. I think specifically for Capital Constellation, like this current environment is super exciting because we're going to get the best investor entrepreneurs in this environment. It's a tough fundraising environment. People see that there will be a great investment opportunity in the horizon, and they're willing to take that risk. And by us providing them with the 200 million or so of capital to keep their lights on and weather that storm and be able to incrementally raise capital on top by being aligned with a large network of asset owners, that's something that excites me greatly in this current environment.
Yeah, I think couldn't agree more that this environment is one where I'm sure we're going to see a lot of blow-ups. I'm sure we're going to see a lot of people who, to your point, the denominator effect, just can't raise funds or have to mark portfolios in some other way. Do you think there are outlets for that? It's the secondaries market. A lot of people talk about as a way to sort of you can get yourself out of those sorts of binds, or continuation funds, or other ways that are you can sort of move an illiquid portfolio. Or do you think that at the end of the day, if people are over-allocated, they're just over-allocated?
Yeah, I think, like financial innovation has been great because, private equity and alternatives in general have been an illiquid asset class for a very long time. And, having these liquidity tools makes it more accessible to investors, but also does create more volatility to it in times of stress. So you're seeing things now trade in the secondary private equity market. It used to be in the high 90s or 90s. Now people are talking about the 80s. So my view is a long-term view. I don't think just because the equities book went down, if I have a high conviction private assets book, I would sell it to rebalance. I think I just don't subscribe to that approach. But the reality is, these asset owners have asset allocation plans that are dictated by, some of the largest consultants, and they have to stick to them. Fortunately, we don't have that constraint.
Yeah, it does seem like a funny constraint, because either, public markets are down and privates are not, in which case they're over allocated, but that, they always sort of catch up over time. So it's a funny system, but so if you think about other areas of opportunity, whether it's maybe private credit or venture or other things that are a little bit further afield, and you think with your long-term view, or parts of the world, are there things that you're really excited about that perhaps other investors aren't quite looking at these days, or are people too focused, narrowly? Are there other exciting things out there that we should be drawing a long-term investors' attention to that might be a little bit off the beaten path?
Yeah. I go back to, like our focus on the middle market, and specifically with Capital Constellation. Like when I think about the groups that we've recently backed, they're focused on buying things for cheap. They're focused on things beyond just financial engineering and, riding a multiplier benefit. So, for example, I had mentioned our alternative real estate investment activity, which, caters to the need of an allocator from a real estate perspective, but doesn't give them the volatility of real estate investing and the cyclicality of it, and offers, private equity-like return. We've applied that mentality to Europe and backed a group there called Grey Kite, that's led by Michael Abel, who used to be at TPG and leading the real estate efforts in Europe. And his focus with his team is on buying platforms and building platforms in real estate. So whether that be student housing or logistics or data centers, I think you have to be more creative within asset classes in this environment. Otherwise, you're just going to be beta. When I think of our last seed deal, Niobrara, where we backed Chip Shore, who is an investor in the tech space with over 3 decades of experience, and has seen so much volatility and cycles and technology. He's focused on some of the themes that are happening now, which, as you mentioned, like the deglobalization, the onshoring. So the first deal that he's done was a semiconductor manufacturing facility in Minnesota. So by being with these smaller managers, you're able to target things that will be either insulated or resilient or benefit from some of the volatility that we're seeing today. We backed a group based out of Dallas, 2 female founders who, they focus on buying businesses only from family businesses, and they have a partnership approach to that. And by doing that, they're always the first institutional capital, and the family seller usually sells for below market because they want to bring in a real partner, and then they're able to grow these businesses. And we're talking about businesses such as pest control, like roll-up strategy, things that are going to be resilient regardless of there's a recession or not. People will always hate insects and pests. So if he can create entry points for these businesses, and then add your operating power to it, then you can really have good results.
Yeah, I think that's it's a very powerful combination to think about, entry point, operating, breaking down some of these silos, long term, sort of that the strong hand at the table, if you will, and when it comes to capital. So, well, it's very exciting. I think that what you all have built is it is a bit of a unique animal in terms of putting these various things together. And of course, what I love about it is the this long-term mindset that you bring to your investments and to your organization. And of course, we appreciate your being part of FCLT and focusing on the long term. So that is very aligned with what we're doing. So thank you for telling us about what you're up to, and thank you for sharing your approach, particularly in these times, so we can get very focused on the short term if we're not careful.
Yeah. And I think that's very consistent. Like Wafra has been around for 40 years. I've been working for the same company for 20 years. So yeah, I've always focused on the long view of things. And we went to the same business school. I remember when we were about to finish, our professor told us that I'm going to have 5 jobs in the next 5 years. I've had 5 jobs, but with the same company. And it has been entrepreneurial, it has been exciting, but, my advice to people is, to stick to that long-term view of things and to have an owner's mentality. Even if you're an analyst, just trying to focus on, can I be entrepreneurial? Can I build something if I don't like the status quo?
That's great advice. Owner's mentality, long-term strategy. All right, we'll leave it there. Thank you very much, Adel.
Thank you so much, Sarah. Have a lovely one. Thanks.
That concludes another episode of Going Long with FCLT Global. We hope you enjoyed our conversation today and encourage you to continue exploring our resources and research at www.fcltglobal.org. If you enjoyed today's episode, don't forget to subscribe, leave a review, and share with others who may find value in Going Long with FCLT Global.